Yes, I know. The bond market doesn't look that great right now. But that doesn't mean bonds shouldn't continue to be a crucial part of our portfolio. In today's video, I want to help you understand why you should still consider investing in bonds despite its pitiful performance the last few years, as well as review the 3 best bond funds I personally recommend to hold in your portfolio. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. Before we get into what's going on with the bond market and what best bond funds to buy, let me briefly talk about the basics of bonds in the first place, and why we would even want them in our portfolio. In the simplest terms, bonds are loans. When you buy bonds, you're essentially loaning money to someone, in this case to a company or a government agency. And they're an important addition to a well-constructed investment portfolio because of how different they are from stocks. A good analogy I like to use to frame stocks versus bonds is to think of them like engine versus the brake. Think of stocks as your core wealth-building engine. Without it, you really aren't going anywhere. And think of bonds as your brakes. Without it, you could drive yourself off the road. When you have bonds in your portfolio, it helps to smooth out your investment ride because though they have lower returns, they have less volatility. The general rule of thumb is that you want to start adding them to your portfolio as you get closer to your retirement age. Alright, with that said, if you looked at the latest bond market trend, you might have noticed a few things. They've been falling. For example, the Vanguard Total Bond Market Index Fund, also known as VBTLX, has fallen by more than 15% since the beginning of the year. So what gives? Yes, when we look at the past year, bonds have had a pretty rough time. Based on some numbers, this could be the most devastating period for bonds since at least 1926. So you might have doubts about putting more money into the bond market. However, as bad as things are right now, history and basic fixed income math will tell us that we should start seeing some relief when the interest rate stops rising. Thus, the greater importance of ignoring the turmoil of the market and just hanging on to well-diversified holdings in low-cost bond index funds that we'll review here in a bit. Of course, we don't know exactly when they'll happen, but most bond investors should expect to benefit if they can ride out this upheaval and hold on to their bonds. Let's understand how the bond market moves in relation to interest rates. Bond prices and interest rates move in opposite directions. That is simply the way bond works. Rise in rates lead to drop in existing bond prices as newer yielding bonds are issued. And when there is a steep rise in rates, as it is happening right now, a steep dip in bond prices. It's easy to forget that the Fed was holding the federal fund rates at around 0 as recently as the first quarter of 2022. But once the Fed decided it was time to do something about inflation, it moved forcefully and raised the Fed funds rates by 3 percentage points in about 6 months. The current federal fund rates are between 3.75 to 4%. But if history can teach us anything, this has happened before and we have recovered from it before. The last time the Federal Reserve had to deal with inflation this high was in the early 1980s during the start of the Reagan administration. Paul Volcker, who took over as the Fed chair in 1979, vowed to raise rates until inflation got under control, no matter how much it slowed down the economy. Volcker argued that short-term economic pain far outweighed the long-term damage of inflation. If you can believe it, at one point, the Fed's benchmark interest rate rose as high as 20%. Puts our 4% in perspective, right? Then after tightening rates for several years, Mr. Volcker decided in the latter half of 1982 that it was time to relieve the economic pain. This was a turning point. Interest rates fell and the market rallied. For bonds, according to several measures, it was the best year of the last century. The Bloomberg US Aggregate Bond Index had an average annual return close to 33% in 1982 and had positive returns every year for the next decade. Now, I'm not saying that identical things will happen this year or next year, because no one can predict the future and the timing. However, if for long-term buy and hold investors, history and fixed income math should give us some sense of direction and hopefully comfort. Despite the weakening economy, bonds should eventually rally back up once interest rates starts falling again. Some experts are even saying that it's likely most of the damage in the bond market has already been done. The average yield for high-quality bonds in the Bloomberg Aggregate Index is almost at 5% because interest rates have risen so rapidly. Now, however, the forecast for the overall economy is a different story. With average mortgage rates at 7%, the housing market is definitely feeling the impact. And when we add up all the events happening around the world, continual war in Ukraine, lingering pandemic, and energy shock, it wouldn't be a surprise if we fall into recession soon. But like all cycles in the past, when the economy weakens and unemployment rises, inflation should come under control, and by then the Fed will decide that it needs to relieve the economy and start pushing down the interest rate to stimulate more spending. And the cycle will begin again. When we wind the clock back to 1982, we see an example of where the Fed made the interest rate pivot and both the bond and the stock market embarked in a long journey up. Now, nobody can say with certainty that this will happen going forward, but I myself am confident that with the long-term perspective of the future, the bond market will start to make its pivot and will continue to be a crucial component to our well-balanced portfolio. And this is also a good time to point out why it is so important to hold a healthy level of cash in your checking or savings account. Market cycles come and go, but it's almost impossible to predict the timing of all this. When will the inflation come back down to a healthy level? When will the Fed start to lower interest rates again? I wish I knew. Therefore, you want enough cash to be able to ride out the many unpredictable bumps in your investing journey. We never want to place ourselves in a position when we're forced to sell assets that have fallen in value because of personal liquidity issues. Hold cash and hold a lot of it if possible. Now, with that said, you also want to make sure you're holding onto the right bond funds. Because in order to benefit from the rally up of the bond market, you want to hold funds that are netting new investments by replacing low-yielding bonds with higher-yielding bonds. And the best funds that are doing that are low-cost bond index funds with built-in self-cleansing mechanism. Here are what I consider the 3 best bond index funds to include in your portfolio. The first bond I recommend is the Vanguard Total Bond Market Index Fund, also better known as VBTLX. VBTLX has an expense ratio of 0.05%, which means if you have $10,000 invested in Vanguard Total Bond Market Index Fund, you're essentially paying $5 for Vanguard to manage this fund for you. This one fund represents over 10,000 individual bonds. The fund's investment objective is to track the performance of a broad market-weighted bond index, therefore it tracks the Bloomberg US Aggregate Float Adjusted Index. This one fund provides broad exposure to the investment-grade US bond market. And when you hold a broad market-weighted bond index that tracks very high-quality bonds, a lot of the risks of holding individual bonds such as default, interest rate, and inflation risk are all mitigated. VBTLX also has a minimum investment requirement of $3,000. If investing $3,000 seems like a tall order, you could also consider the ETF equivalent, the Vanguard Total Bond Market ETF, also known as BND. The nice thing about BND, in addition to not having a minimum, is that it has a lower expense ratio of 0.03%. So you want to weigh the pros and cons of investing in an ETF versus a simple index fund. Another nice thing about starting out with an ETF is that you can convert to an index fund once you hit the minimum of $3,000. The second bond fund I would recommend is the Fidelity US Bond Index Fund, also known as FXNAX. It has an expense ratio of 0.025%, which means if you have $10,000 invested in Fidelity US Bond Index Fund, you're essentially paying $2.50 for Fidelity to manage this fund for you. It holds approximately 8,400 bonds. It tracks the Bloomberg Barclays US Aggregate Bond Index, which is composed of investment-grade government bonds, corporate bonds, and mortgage-backed securities. Top issuers are US Treasury or issuers of mortgage-backed securities like Fannie Mae and Freddie Mac. And a nice aspect of investing with Fidelity and with FXNAX is that there is no minimum to invest. You can start investing with whatever you have. If you're already investing with Fidelity and have been looking for a solid bond fund to hold, I highly recommend the Fidelity US Bond Index Fund. The third bond fund I would recommend is the Schwab US Aggregate Bond Index Fund, also known as SWAGX. It has an expense ratio of 0.04%, which means if you have $10,000 invested in Schwab US Aggregate Bond Index Fund, you're essentially paying $4 for Charles Schwab to manage this fund for you. It tracks the Bloomberg US Aggregate Bond Index, a broad-based flagship benchmark that measures the investment-grade US dollar-denominated fixed-rate taxable bond market. The index includes treasuries, government-related, and corporate securities and mortgage-backed securities. Top issuers are also the US Treasury or issuers of mortgage-backed securities like Fannie Mae and Freddie Mac. Schwab US Aggregate Bond Index Fund holds approximately 8,000 bonds. Similar to investing with Fidelity, with Charles Schwab and SWAGX, there is no minimum to invest. If you're already investing with Charles Schwab, I highly recommend the Schwab US Aggregate Bond Index Fund to round out your portfolio. That's it, guys. Thank you guys for watching. I know bonds are a complex and broad topic, and we've only covered the surface of it in this video, but I hope it gives you some context to the current bond market. The bottom line is don't be afraid to hold some bonds in your portfolio. If you're just starting to dabble into the bond funds, start small so you can get used to holding them. Thank you guys for watching, and if you'd like to learn more about what stock funds go well with these bond funds, check out a few of my videos here. Until next time, all the best.